We can start now. Good evening from India. A warm welcome to everyone joining us from across the globe. Whether it's your morning coffee or from New York, lunch in London, or post-dinner relaxation in Singapore. It's great to see you from the global reach perspective, our NRI diaspora, and we are thrilled to have you here. Due to some unforeseen health issues, Abhishek from our team won't be able to host this session. I am Sushid Raj from SBNRI, leading the wealth division, and will be stepping in to take over and ensure a seamless experience for everyone. Thank you for understanding. Many of you already know me via the YouTube channel, or I am managing your portfolio, so that may be one of the reasons. It's absolute an honor to host this exclusive webinar designed especially for our NRI community. Joining me today is none other than Mr. Asit Bhandarkar. He's the senior fund manager from JM Financials. He has over 2 decades of experience into equity research and fund management. His last assignment was as a fund manager with Lotus India Asset Management Company as a junior fund manager. He started his career on the broking side as an equity analyst. Now he is managing close to 4,000 crores across various schemes of JM Financials. Before we dive in, just a couple of housekeeping notes. Please keep yourself on mute for a smooth session with our speaker. Chat box is there as your playground. Use it to ask all your questions. Share your thoughts over it. even tell us where you are joining from, what you have your requirements, what type of particular questions you have. Just feel free to ask that on the chat box. All right, so now we have set the stage. Let's start. Mr. Asit, good to have you here on board with us, with our audience.
Hi, Sashidhar. Uh, I mean, it's evening here, and I'm sitting in Bombay. And as some of your clients may be aware, we just wound up a local election recently, and the results are out today. And I don't know if you can catch out there. I stay at a place where there is a MLA close by. So, yes. So pardon me if there is some noise intermittently, but yes, I think in India, like everything is a
I can understand.
Everything is a celebration, including yes, we like to celebrate everything, including elections. But yeah, I guess now it's catching up globally. I guess my friends here on the call from US would sort of relate. They've gone through something like that a little days back. I think few days back. Anyway, please let's begin.
Done. So Asit, as he is a strong believer and proponent of the great India story, and we are going to talk to Asit on a various of subjects around the whole Indian phenomena, including the political part, the global aspects, everything we will try to cover in short. And that will surely give you a very fair idea about how India is growing and what is the next path, what we see after 10 years, 15 years. Yeah, so we will cover that. Recently, I read a study that says that it's India's decade. The stars are aligned. This is how people are putting and talking about India. Even the bigger influences, they are speaking about India. So I want to ask you that are we fundamentally, structurally prepared to be the center stage of the global growth? Are we really for the expectation that the world has set on us?
Sure, I think that's a very good question, and I'll try to put my position as crisply as possible. See, it's always been India's decade. I've been in this business for like more than 2 decades now, and I think I remember grossly around 2007. I think they used to say BRICS. These five nations would sort of be the next future of this world, etc. Right, and time has passed. Yes, I mean there are a lot of expectations from India right now. India has potential. So if you ask me, am I a firm believer in the India story in the sense that do we have potential as a country? Yes, we have, because in all the countries which have gone from a low income to mid income and then subsequently mid income to high income curve. There have been, a lot of similarities in the sense that there has been a very strong pool of young workforce. There has been strong domestic demand. There has been, a global macro environment which is sort of supportive. And we have seen countries transcend this growth. Just to put it in perspective, I think China would be at the per capita income where in 2006 where we are today. So just to put it in perspective, then probably we are about 2 decades behind China in per capita income. And the scale change that happens with per capita income changing is staggering, because on the consumption side, perhaps China has been a wonder as far as manufacturing being factory to the world, etc. is concerned. That's a different path, and I will go there for a bit. But if you actually see, if we have, if I'm not wrong, I think we have about 500 odd McDonald's stores in this country. If you put both the franchises put together, it will be still about 800 stores. If I'm not wrong, I think China has 10x that, or maybe a little more, right? Somebody told me that, bubble tea, there are some 50,000 stores in China for bubble tea. We don't even have a chain, right? And so my point is that they have gone on a steep path where their per capita income kept on increasing multifold, and we are on that path. So yes, so if you see us, we will go from $2,500 to say 5,000 very quickly in a matter of say 4 or 5 years, and then subsequently keep multiplying, and hence demand for a lot of products will increase, wealth creation opportunities will increase. But the caveat is, your question was very well put. Will India sort of fulfill the expectation that people have of us? See, there are a lot of things in the sense that yes, we are a young country, so but that means people need to have jobs, right? If they need to be gainfully employed, that means industry has to come, or service sector has to boom. Yes, we are, there's a confluence of factors which sort of pushes India towards, we all have heard of China plus one. So that's one thing where manufacturing is sort of looking up. In my whole career, I've just seen manufacturing shrinking as a percentage of GDP every year. And now, in last few years, whatever we are seeing on the ground in terms of what the government is doing, what the global confluence of factors are bringing together, I'm sort of getting optimistic that probably, manufacturing uptick will come through. But I think we have to understand. See, we can't be complacent about it as a country. There is no manufacturing setup can come if infrastructure is not great. The size and the scale of our infrastructure needs to grow multifold from here. It is staggering to see the kind of infrastructure that exists in, say, China, for example. It's so staggering that even US today feels that it's sort of left behind, and they are now on their own path of rebuilding infrastructure. So there is a lot of work to do. There is a requirement where there is some execution that will be needed, where all of us as individuals will have to participate. The government will have to do its role, and industry will have to do its role. So confluence of all these factors. But I would say that what next 25 years, probably gives us is an opportunity because of a great demographic dividend to break out from a situation where we have been for last 77, 78 years, where we have been a low income, low growth economy, to being a high income developed country. We can do that in 25 years. That's what the broad demographics and the growth parameters that we are right now on, growth path that we are on, that's the opportunity that we have, right? Will we make maximum of it? We have to see. We will surely improve our lifestyle from here. We'll surely be more wealthier collectively as a nation, individually. There will be opportunities which will continue to grow in this country because our GDP growth will go up the slope. My biggest concern, if at all, is that will we become a developed economy by say in 2045 to 50? I think I hope I live long enough.
That was one of the question I was about to ask you.
Yeah. So I hope I will be around to see that, and I'm fairly optimistic to that. But that said, I would say that like confluence of global factors has come together, confluence of local factors has to come together. The momentum has to continue.
So you see the opportunity to grow because we are, as you said, that we are already 2 decades behind, and therefore the way the youth are growing, their per capita income is growing. You see a good potential, and that gives us the hope that in the next 20-25 years, this should be or this can be a developed country.
Yes, that India will grow year on year is not a doubt. Okay. But will we grow fast enough to break out of the middle income country trap and become a developed country? That is the whole game. Because see, if you see in the history of capitalism, a lot of countries have gone through our path. So, it's not going to be too surprising to your investor because it will happen, right? We have progressed in spite of all the challenges the country would have faced in the last 25 years. And in the next 25 years also, we'll go progress. But not many countries have been able to break out of the mold of middle income to that developed economy. A lot of countries have sort of then stagnated at the middle income. But anyway, that's a discussion for another day. We have to be
Yeah.
optimistic, and I would say that we're in the right direction.
Okay, so now let's look at what has dominated the world in the last 6 months. Okay, so there has
Sure.
been lots of election talks, like in
Yes.
India, in US, in Japan, in Europe. Lots of earning talk, which is now getting slower. A lot of
Sure.
IPO talk has had happened. These factors won't play any role in this December or January month or on towards that. Okay, so why is the Indian market correcting is relatively easy? But let's talk about where we are headed and what should an investor do in such a scenario.
Sure. Just I'm sure you guys educate your investors enough, and I think this
Mhm.
general impression, right, that the Indian markets are fairly expensive from a valuation perspective. From a historical valuation perspective, uh, markets are a little, so in some cases, say the mid cap index is two standard deviation above the long term averages. Uh,
Mhm.
uh, now that's one part of it. Second, I think there has been very strong liquidity in the market, especially from the domestic investors, which sort of but it does have an impact on asset prices. Too much money chasing too less.
Mhm.
So what we're seeing now is sort of the 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 balance sort of tilting on that front. What we are seeing is that the supply of paper, if you will, has increased quite dramatically in the last few months. In fact, if I'm not wrong, the IPO pipeline and the amount of money that the corporates have raised in the last few months has
Mhm.
been more than say entire of last year. Probably I can share a slide here. If you can
That would
enable
be great if you
share.
can. Yeah.
Yeah, I can. So just let me know if you can see what I'm presenting here.
Yeah, yeah. It's visible, Asit. We can see that.
Yes, yeah. So just one second. I'll try to make it full screen so that it's more legible for everybody.
Mhm.
So this has been sort of a record year as far as fundraise is concerned. If you see till half of this year, we have raised more
My
money than what
gosh.
was raised in the whole of last year. In fact, if you're a little generous on calculation, I would say
Yeah.
more money has been raised in half the year than probably 2 years combined. That's one. I did mention that valuations are looking a little higher, right?
Mhm.
So although fundamentals of the economy remain solid, it does warrant a little bit of caution from the market side, and collectively, I think market has sort of reacted to these things and sort of slowed down. What we have also seen is that there's been a little bit of a reaction, I would say, uh, uh, from the, the election results that came through. And to that extent, we have seen FII flows remain negative, right? We have seen
Right.
FIIs sort of exit India, and I don't think it's linked to elections here, but generally, I think yeah, they have options. They have cheaper markets elsewhere. They have looked at that option. They have also seen the fact that there could be the point that you're making, that so many countries are going into election at the same time, and all the major economies actually. UK had an election, Japan had an election, so policies can change. So to that extent, some money has been coming out of equities, and we've seen FIs continuously
Right.
sort of lighten. And we've also seen the fact that US interest rates, which sort of had been significantly high over a few last few years,
Mm-hmm.
they have started to come down. And typically, when interest rates come down, even fixed income tends to make decent returns. And I think some bit of it, FIs perhaps have sort of tried to take advantage of this phenomenon. I'm just sharing a slide in front of you. This is our interest rates and the PE of the market, right? What typically happens
Yeah.
is in the long run, and I think this is the tailwind. In fact, this is the tailwind that we have for stocks going ahead, because I think
Mm-hmm.
the corollary to your question is markets are correcting, should you be afraid, right? What this
Yeah.
shows is that when interest rate cuts begin, right, the PE of the market goes up or is
Mm-hmm.
protected. There is an inverse correlation. There's a very long period. I think this period is almost 18-year chart that you can see. And this is for the Indian rates, because global rates got cut, Indian rates also got cut a little bit. And you can see that in that sense, in a reducing interest rate environment, markets tend to have higher P. But as I said, little bit of a demand supply, little bit of FIs continue to having more attractive options
Yeah.
elsewhere. So demand supply has sort of ensured that the markets have pulled off, and I would think that is very healthy because see, over the last 2.5 years, every month that you were late to allocate money to the market, you got it more expensive next month, right? Uh,
Right.
I think typically what happens is when you get something more expensive next month and next quarter, investors who have a large pool of money, don't see value. So I have seen a lot of investors sort of step back and say, "Boss, it's gone up. I can't invest in it." Right?
Yeah.
The
Yeah.
fear
True.
sets
True.
in because So now I see a little bit of a time correction, a little bit of a downward movement in the market without any financial crisis on the annual. Government health is good, taxes are good. There may be some news flow here and there, but broadly, things are fine. So it's giving a great opportunity for investors to allocate money over, say, next 3 to 6 months. Post
Mm-hmm.
which, I would believe that at least most of the elections will be over. We would know what are the policies that the largest economy in the world would have, right? How the terms of trade would be set, whether the wars that are around in the world, whether they'll continue, not continue. A lot of this clarity will come in the next 3 months. And India itself, perhaps, should also embark on a rate cut journey, right? So, all in all, I would say that in that sense, for an investor who is looking to allocate and who's sort of not been able to allocate money over the last few years because he continuously
Mm-hmm.
saw market going out of his hands,
Yeah.
it's a great
Yeah.
opportunity. And from an investor who is already invested, I mean, should he be afraid? And oh, are the markets going to collapse? Not really. I think market has been reacting to some bit of adjustment, if you will. As I said, what typically happens when markets become expensive on a PE basis is that there is a sectoral rotation that happens. Money moves from a more expensive sector to a cheaper sector,
Mm-hmm.
and then so on and
Mm-hmm.
so forth. And we are in the midst of that, right? What we had very clearly as a trend for last 3 years, and our portfolios benefited substantially from that trend, is that the manufacturing and investment environment had improved dramatically. Companies had cleaned up their balance sheet, they were debt free, so they could invest. And hence, our
Mm-hmm.
portfolios, we saw a significant overweight in industrials and manufacturing that benefited us dramatically. But what has happened is the sector where the visibility was maximum had become just too expensive. We had stocks, some of them trading at 100 PE, etc. Right, so the
Mm-hmm.
little bit of a correction was warranted there. So some money has come out of there. These stocks have corrected 20-25%, although the market has not corrected that
Yeah.
much. And that money probably would have gone into sectors like consumer, healthcare, just sort of defensive sectors, IT, where the
Mm-hmm.
growth is not as much, but as an investor, you feel your money is a little safe because those stocks have not participated in the last 3 years. That said, as some of the stocks become which were very expensive, but we had a very broad-based long-term story, if they become 25% cheaper, I think there are a lot of people who will be willing to look at such stocks, and we are also
Right.
salivating at such opportunities in our portfolio because you know. For us, instead of this headache of doing sectoral rotation here and there, it's best to put money into a long-term structural story also.
Mhm, mhm, mhm. So, can we say that the market has corrected itself? So, for the new investor who are sitting a lot on the cash, who did not deploy their money in the past, let's say 1 year, is this a good opportunity that they can take advantage because the correction to a good extent has already taken place?
Yes, see, what I'm saying is mentally be prepared for volatility. Why? Because yes, see, there were some domestic questions, right? Uh, because some people felt that government may change its course here because they
True.
were weaker, right? They will say allies will run the government, and uh, but as time is passing, you're seeing not much has changed, right? Uh, so those fears will subside. There is, from a global perspective, there is a general lack of understanding about what US will do. Because see, Trump had a fairly disruptive impact on global trade in the first term that he had enjoyed. We will, and I think collectively the world would like to see what his stance will be. So all these things will become more and more clear over next 3 months. Interim, there will be volatility. Right? Interim, there will
Mhm.
be volatility. Mentally, we should be
Yeah.
prepared for it. And what I would say is, you should take advantage of it. Right? The
Right.
broader, I
Right.
think the bigger, I think your seasoned investors will want to think whether this is going to be like 2008, whether stocks will go to pennies, whether we'll lose 50%. I don't think we are
Correct.
in that kind of an economy, either here or globally. you know uh, uh, of course, never say never. There could be unforeseen circumstances, but I mean, that's par for the course. You cannot make an investment plan based on such hypothesis. Broadly, if you ask me, things are quite fine. The visibility is very high. Things are in the right
Mhm.
direction. And any investor who wants to take a 3 to 5 year bet, this probably will be the best time.
Right. So whoever is planning to invest for a longer tenure, it doesn't actually matter much, but this will act as an opportunity for them since the market has corrected. Definitely, as you said, that there can be volatility in the market, but that's exactly how the nature and that's how the stock market performs. Either it is
Yes.
anyone, any asset class, and this range. Yeah. Okay.
Yes.
Perfect. Perfect. Now, coming on to JM Financial AMC. So, they
Correct.
place a significant emphasis on investing in. Uh, sorry, is someone saying anything? All right. I was talking about that. You put a lot of emphasis on investing in high quality companies, which are adapting towards the market trends. So, can you share how the strategy is implemented here in your current portfolio and how you balance the pursuit of growth opportunities with the need to mitigate the risk in such volatile market conditions?
Sure. If you permit me, I'll just share a couple of slides, which I think will make it very
That
clear
would be
for
great. Yeah.
audience as to, yeah, how we do things. See, we are a fund house, which is a philosophy of investing in growth companies. And if you see, the say 10-year performance of the best stocks in the Nifty today, and I'll just take names. Please don't take this as a recommendation, but this is just for you to understand my point, right? You will see the best performing stocks would be something like say a Titan, a Bajaj Finance, or probably an
Mhm.
Asian Paints or a Pidilite. And if you see on the screen, what is common with all these companies is that they have a massive opportunity size. Right? India is a poor country. Asian Paints will see people becoming more and more richer, and having fresher walls, etc., etc. The growth that these companies have, exhibited, will has been significant and will continue to be significant. If you see from a valuation perspective, though, I think is very important to understand, right? None of these stocks have ever been very cheap. They've been always expensive, right?
Yeah.
So our belief and why we have made the philosophy like this is that you cannot ignore a stock which is slightly expensive because it's growing faster than this country, because the growth journey can be very long. For example, I think in consumer stocks, this is prior to our generation, but say an HLL would have grown from 1980 to 2010 at a double digit
Hmm.
pace every year for 25 years, right? Because that was the need of the nation. I mean, people did not, the basic goods were getting sold, biscuits were getting sold, this was getting sold. Will change as the per capita income changes. As I said, if you go back to my earlier example of a quick service restaurant, etc., those things will grow that fast. These, as we see today, you would see that a Hindustan Lever doesn't grow the way it was growing 20 years back anymore, right? Because it sort of peaked out in its opportunity. So our objective in our philosophy at JM is to capture these kind of opportunities early, right? Don't overpay for them. Look at the PEG ratio. So just broadly to say that if a company is growing at 30% every year, I may pay a 40 PE for that company, right? I won't pay 100 PE, right? Because a
Hmm.
PEG of 1.5 is, manageable, but PEG about
Yeah.
2 is sort of beyond our comfort. So what you will see is there are some stocks which are extremely expensive out there, which may be trading at 100 PE. We are not there in those stocks, right? Although they may represent the growth and the opportunity, right? But the other point that you made about quality, I think that is very important. I'll tell you why. Because typically when you chase growth, you also get into problems. Because all the companies which probably have collapsed in the Nifty, say the Future Bazaar Group, Pantaloon, or some of the other names like Jay Prakash, which is a Nifty stock about 10 years back, right? Suzlon in its earlier avatar, one of the world's largest renewable energy company, then collapsed. And
Yeah.
what happened? I think our trick in our model has to be that how do we play growth at a reasonable price but avoid such accidents? So we have put quality parameters there. First of all, I think, see, our tolerance on debt is very less. So because unlike the developed countries where your clients might be sitting, uh, debt is fairly expensive in this country. It is not cheap.
Yeah.
Loans were never at two
Not at
percent
all.
right? And on a bad day, the bond markets are not deep enough to give you liquidity, right? So what happens is, I remember reading an article where Gautam Singhania of Raymond's, we all know the lifestyle that he leads. I'm sure he has 50 cars which cost 5 crores each and all that. But he says in his interview that during COVID, to pay some liquidity, he couldn't get a 5 crore loan from the banks. And that's where he realized that he has to do something and restructure, etc., etc. So that's the broad
Hmm.
point. So we are debt averse. We prefer our companies to be less than one time debt equity. We prefer the companies to have very strong ROE, generate more than 15% ROE, ROIC. And now just put that in context of the companies that I mentioned earlier. All these companies that have grown fast have had very good ROE. They've generated very strong cash flow. They have not diluted their equity to grow, right? See, the point is, if market conditions are not good, you will not get equity. You cannot see the IPO market that exists this year. If you had gone and tried to raise money in 2020, you wouldn't have been able to do it. That year, perhaps only a Reliance Industries or some of two, three blue chip companies would have been able to raise money, right?
Yeah.
So, so,
The
so
giants.
the company would need to generate cash flows on its own for its growth, right? Yes, you're growing at 30%. Yes, you're growing at 25%. Yes, you're growing at 15% plus. But how are you funding that growth? So we prefer companies which generate very strong operating cash flow, which do not need. So just for example, Titan has gone from virtually no stores in the jewelry segment 20 years back to I think the overall, including the Lenska, the Titan Eye and all the stores put there, I think 1800 plus stores now. And they've not raised money ever. and they have not taken a bank loan ever, right? So that is the thing we're trying to play. Quality companies, high growth companies with strong cash flows is what we bank on. One more thing, I think, and although you not touched upon it,
Mm-hmm.
we, the way we manage quality is not just by the stocks that we buy. It's also we've also built in the fact that our returns have to come with minimum volatility. Volatility scares everyone, right? So if the stock is up 20% today and it's down 30% next week, and then going to be up
Mm-hmm.
50% the week after, it's going to cause a lot of heartburn to people, right? That is not what we aim for. We are okay with 1% coming through a month peacefully, no problem. But the direction that we want. So minimize volatility. So I think what you will see is that although our portfolios are extremely liquid, we are chasing returns, but our portfolio betas are less than one. For the alpha that we've created over a period of time, where we consistently beaten the index, we have done that with minimum volatility. Beta of all our portfolios is less than one. So we prefer to hold. So if there are say choice, for example, there are two stocks which we feel will probably go up by 20%, but one has a higher beta and one has a lower beta. Our bias will be towards the lower beta stock, even if it gives me a couple of percentage returns less.
Mm-hmm.
And the third thing, what we have put in our in our process is to be dynamic. See, the market catches fancy with a lot of things, right? Uh, I'll go back to my earlier example, right? Suzlon was one of the world's largest wind energy companies when wind energy, rather the green energy was
Yeah.
just a concept, right? And by the time green energy became mainstream, they were almost bankrupt. They're coming back now, but it's a different company totally, right? So my point is that you have to be dynamic. Just taking a macro call and sitting and not monitoring your portfolio can be disastrous for your portfolio. And we, being active fund managers with daily NAV, we do that. So we continuously look for problems in our portfolio. Where are the problems in my portfolio? We evaluate all this on a 1, 3, 6 month basis. And
Mm-hmm.
wherever we see consistent underperformance of the portfolio, of a stock within the portfolio, it becomes a feedback mechanism for my research. We take action, and we probably, if we don't get good enough answers, we get out of such stocks. What it does is that on a constant basis, our portfolio continues to remain fresh, because I know I've sold something, I have to buy something, I'll buy something which I think on that day is better. Right. So although we are not traders, but I think this is a very important metric, you know, less understood, but very important to give consistent return. Because see, point to point, returns will come. This is a country
Yeah.
where per capita income is going to go up. Things cannot go wrong. After 10 years, probably, the L&T stock may be higher, or, Hindustan Lever also will grow less or more, but it will grow. It will be a bigger company than it is
Mm-hmm.
today,
Mm-hmm.
right? It's not a big thing to make money in India because we are a high growth country, right? But
Yeah.
how do we make sure that we beat the index in a superior manner is by reducing our mistakes, right? And that's the thing that we have sort of put here. And I'll just give you a couple of slides which sort of, will tell your investors how, active management changes things. Okay. Now just look at this is one market cap moment. Can you see that?
Mm-hmm.
Is my slide visible?
Yeah, yeah, it is.
Yeah. Yeah. So the point I was trying to make is have a look at this slide. This fund on the quarter COVID hit was 90% almost in large caps. High risk period.
Mm.
Okay. Small cap was zero that time. Okay? As things opened up, we moved money towards the mid cap segment. If you see, even in September 20, small cap was zero. Then,
Right.
as we
Mm.
moved into 22, and I will just request you to jog your memory. 22 was a terrible year for small caps in this country. Small cap index, I think, was down some 18%. right? If you see,
Mm-hmm.
our small
Mm-hmm.
cap weightage was minuscule, single digit, 3%, 4%, and all that. And post that, as we closed the calendar year 22, we saw that the stocks had become very attractive, and we moved from say 5% small cap to 15% small cap. And that journey went almost up to June 24 when we were 39 to 40% small cap. So point is, we've gone from at the peak 90% in large caps. And I would like you to focus your attention on the table below also. See, between March 20 and September 20, had we not moved to mid cap, the mid cap index, instead of the large cap index giving 36% in that period, gave 47%. So I generated
Right.
extra returns by moving to that mid cap segment. And similarly, through 23 and 24, you have seen we've had such a massive small cap rally. And had we not positioned ourselves well there, we wouldn't have made the extra alpha. See, a lot of people also ask us, uh, you have given 7, 8% alpha, 10% alpha over the index. Are you taking more risk? No. We are following data. We are being smart. We are just placing our bets where the market is moving. This is the example for that. And this is not just with, market cap movement. If you see, even with sectoral movements, we are very dynamic. If you see the consumer durables index in front of it, I think it's beige kind of a color.
Mm-hmm.
And just focus the color, don't strain your eyes. The
Yeah.
point is
Mm-hmm.
that you will see that it is at some point of time 10.71%. At certain point of time, it's 0.93%. Look at the dynamism. That means I am buying that
Mm-hmm.
sector. I'm looking at the fundamentals. If I don't like it, I'm selling it, and then I'm buying it again. So the sector was 10.7, it went down to 0.93, and from 0.93, it is now gone back to 7. This is active fund management, right? And this is the kind of philosophy that we have embarked on all the time. And I just give you an example here. Look at the auto stocks, right? Auto was what? I think 3.52 in March 20. September 20, you'll see that we've tripled the holding to almost 10%. Why did we do that? If you jog your memory again, you will remember that, there was a time when, of course, nobody wanted to share a ride anymore. Everybody wanted a personal vehicle. And because
Yeah.
of semiconductor issue, vehicles were not coming through, right? So demand doubling, supply halving. It was a dream time for any auto industry. And look at the sectoral performance in that period. The BSE 100, which is the large cap index, went up 37% between March and September 20. But the auto index went up 69%. So obviously, us tripling our holding into that sector generated additional alpha. Had we kept 3%, we wouldn't have made as much money. So this is the point I'm trying to make, that being dynamic has been one of the important cornerstones of our philosophy and the way we manage our funds. I think I gave a longish answer, but I hope I made my point.
No, that was incredible, Asit, and this was very helpful for the having the understanding overall about JM. Yeah, you guys are actually doing a great job. Yeah.
Thank you very much.
Yeah, coming on to another question which has its relation with the elections, because like everyone was eyeing towards the US market. So the recent US elections, it has brought about a lot of changes in the political landscape, the potential implication for global trade and economic politics. How do you see these developments impacting the Indian market? I think this is a common question which is there inside the mind of almost all the investors who actively monitor the Indian market. So, particularly in terms of FII flows, currency movement, the key sectors which are likely to get impacted, like ITs, pharmas, who have significant exposure to the US. What do you have to say about them?
See, I'll tell you very frankly, that as I initially said, Trump's administration first term was fairly disruptive to global trade, right? They have changed a lot of dynamics. I think and he's brought out a situation where a lot of work is now starting to happen in US. In fact, you had earlier mentioned China plus one. I think the biggest beneficiary of China plus one is not India, not Vietnam, not Thailand. It is actually US, because the amount of businesses that are opening up in US, it's not happening anywhere. Because the cost of land is the lowest there, cost of fuel is the lowest there, and it's the world's largest market. If I'm finally making it for US, why don't I put a plant there in US itself, especially if I'm an energy consuming business, right? So,
Mm-hmm.
these are the things that have happened. But, to our mind, two, three things. While I am sharing a chart which sort of, answer some of your questions, I would just like to say two things. Whatever the Trump campaign said, okay, can be inflationary. When Trump came in last time, the interest rates were very low and there wouldn't be any negative impact. Inflation was not such a big concern, right? But now, if I'm going to go and put tariff on India, China, and those, I mean, at the end of the day, some of those products are going to come to your country because not much is manufactured there, even yet, right? It will add to the inflation, right? And because if I'm going to put any tariff, say, on garments coming out of India, those garments are going to be expensive, and that means your inflation will go up, right? Which means that the rate cuts, which are giving that essential relief required by a common American today, will stop and could reverse also. So it's not going to be so easy, is my point. It is not going to be as easy as the first term. My feeling is that there'll be a lot of talk, lot of bark, but less bite, right? Because if 60% of imports coming from China, if they're going to have 20% tariff, it will disrupt deflation. It will cause a lot of problems. It will cause problems to China, yes, but it will cause much more problems in US also, right? Uh, from a positive perspective for us, okay, suppose he has differential tariffs where China has more tariff, India has less tariff, maybe we benefit. That could happen. But I wouldn't bet on that because, he wants to make America great again. So, they want America
Mm-hmm.
manufacturing base. But see, look at it this way. If we move the plant to America, who's going to work there? They are not able to find staff to man Walmart counters, right? I'm hearing of Starbucks having to shut stores because they couldn't find manpower, right? Immigration has become an
Yeah.
issue, right? So in that sense, I think it's not going to be easy to walk the talk again, right? Uh, Third point, I think, typically a Republican administration is pro-oil, and I think it is very, very clear that, there's no point holding on to oil under the ground for dear life, and rather, move that and sell it. That would be beneficial for India, right? Because India's
Mm-hmm.
bugbear typically has been that we've depended on, foreign oil for our energy needs, and any volatility there tends to completely destroy our fiscal situation. I think more oil from US is going to be extremely beneficial from a structural perspective for India. So if somebody wants to look at 5 years and Trump is going to be there for that period and he's going to pump more oil, that's
Got
going
it.
to be very good for India, right? But in a nutshell, I mean, let's assume for our thought process that whatever he's saying he'll do. So we should be prepared for higher inflation, a little higher rate. Uh, Expectation of rate cut that are there globally may temper, and it will cause some volatility, right? There could be a scenario where the dollar is stronger, which means rupee could depreciate. That situation is there. Not just rupee, but when dollar becomes stronger against all currencies, that could happen.
Mm-hmm.
But these would be transient. You know, Impact. See, from an India perspective, if rupee becomes weaker, a lot of export-oriented business like IT, pharma will start doing very well, right? We are
Yeah.
starting to build capacity in defense of exports now, gems, jewelry, apparel. We'll become competitive everywhere. So
Mm.
it we there will be pluses, there will be minuses, but broad point is when these things happen, it could cause volatility, which is why I said for an investor today, be prepared for mentally for volatility over 3 months. Outcome might be much better than what we think.
All right. All right. Perfect. Perfect. Another thing which is very popular nowadays. So as you say that India, this is the investment designation right now. Okay, so there has been an introduction of the new system or the model which is now referred as gift city. Yeah. So
Yes.
this is there was a lot of constraint which we used to see in the past that people or foreign investors, NRIs, OCIs, they want to invest, and currency is one of the concern, the depreciation part. Okay, so Gift City allowed them to invest in their currency in the US dollars also. Okay, what significant role in India's landscape you see the use, the benefit of this asset class? Do you see that this is a good add-on to an investor's portfolio because the current ticket size is also a little higher?
See, I'll tell you very frankly, I'm not an expert on Gift City matter, but from what I understand, because I interact with them on various forums, and the feedback that I get from people who interact with them also is that they're extremely efficient. You don't feel like you are interacting with the government, right? So see, it's a new embarkation. So that means a lot of, policies will have to be made overnight. Some things will be encountered new. So they're very dynamic. What I hear is that, you send a mail in the morning, in 2 hours, you get a reply, your problem is solved before the end of the week. Things are done. So it's operating like a private corporation. So I am very, very sure that Gift City as a concept is just going to grow from strength to strength here, right? Of course, the taxation is an angle there, and every February we have a budget, so taxation keeps changing in this country, right? So that we have to be mentally prepared for. But your currency point is very well taken. The fact that it gives an investor a way far more convenience, because see, India that way has been a capital, conservative country. We don't have capital account convertibility. So getting money into the country and taking it out has been a headache. And I would think Gift City will make it easier. Second, a lot of businesses on the fund management side will keep off. So my point is, the choice that you have on that platform will keep going up month on month, year on year, to a point where for an NRI or a foreign investor, it might become a mainstay. Right, the products will keep getting sophisticated, and I guess it will have its advantages also.
Got it. Got it.
So directionally, I think without being an expert, I'll just say that it's going to grow. So keep watching it. That's all I say.
Right. It's like effortless, and the efficiency part, it's so efficient. Like normally, if a foreign investor or an NRI, OCI has to do their KYC to invest into stocks or mutual fund, the KYC process is a little cumbersome there. Yeah.
Yes.
And that is well taken care of, like within say 24 hours. The second benefit which I see as an investor's perspective is their taxes is simplified, at least for now. Definitely we are not sure about what's going to happen in the future. And the third part, which is well taken care of, that is the currency depreciation part. So it gives them a good flexibility.
Yeah. I think the simplicity will remain. Yeah, I think the simplicity part will remain. It's just that what will be the tax rate and this and that. These things keep changing, so that's fine. I think everybody is prepared. Taxes and death are certain in all geographies, aren't they?
Yeah. We have got a couple of questions. If it's okay, then Asit, we would like to answer them, and then we move forward to conclude it. Yeah.
Sure. Please go ahead. It'll be my pleasure.
Yeah. So one of the question, I'm not sure, you can opt out also, but it is related to the recent conversation and news about Adani case. Okay. So the question is, what will be the impact of Adani case on Indian FDI and the stock market in the coming weeks and months? Do other Indian companies have similar problem or may have What should an investor do in these cases?
See, we are forbidden from commenting on individual stocks in that sense. But since this
Yeah.
is sort of a systemic issue, I'll sort of try and make a comment here. First of all, I think,
Hmm.
see, they are not the first time that they are in news here. First, I think there have been various things that have happened earlier, right? And there have been various things perhaps that will happen in future. uh, it what see that what we have to understand is that at the end of the day, what is that company owning? Okay,
Hmm.
let's for example, in this case, let's say there is some bribery charge. Okay, put the promoter in jail. Okay, but the company does own power plants. The company does own wind energy. Company does own airports. That value is going to be there. So that's not changing, first of all. Right?
Yeah.
Second, I think what has to also be understood is that yeah, they have debt, but is the debt so much that their cash flows can't service them? I think the general understanding, and if you look at the numbers carefully,
Mm.
is that there is no debt servicing issue because most of these businesses are generating very strong cash. When we pass through an airport, I'm paying money. When I'm using their electricity, I'm paying them money. When an industry is using their solar power, they're paying them, right? And so there is money flowing in every day, and they are in some consumer product businesses also. So if you're buying whatever Fortune refined oil, you're paying them, right? Nothing is coming free. Cash flows are there. So even from a debt exposure perspective, I think a lot of things have come in the public press. No one institution is sort of grossly exposed to them. Exposures are
Hmm.
very, very. So it doesn't cause any systemic risk from my perspective. Yes, it has caused this volatility, right? Uh, and to be very frank, it has crossed this volatility we have seen in the past also, right? I think at a particular point of time, uh, people will look at the underlying value of the assets and invest, right? Yes, they may give a governance discount, they may give a governance premium. From our perspective, we do not own any of these stocks, and I'm not making an opinion here, but if I just like you to take back to that slide where I said we prefer to make money with less volatility, right? The volatility keeps us away, but if you ask me, I think the broader question was: is it going to be an India problem? Is it going to be a problem for other corporates? I don't think
Right.
so. I think, see, people, larger corporates from India, say the Birla Group, Tata Group, they've been around and they built their own reputation. So JSW Group, they've been borrowing in the market for 20 years if they need the money, right? And
Hmm.
so
Hmm.
and if we look at the balance sheets itself, I think the corporate culture has changed. The debt in corporate balance sheets will come off dramatically. In fact, one of the things that we get worried about is that there is no credit growth for banks because nobody wants to borrow. The companies are doing so well that
Yeah.
so we are not dependent on debt for growth. All our companies that we are seeing, and the vibrant capital markets are added to it. The first slide that I showed, that companies are raising
Hmm.
money. What are they going to do with that? Either they want to lighten the debt on the balance sheet, or they want to put a new plant and they want to use equity to put that so that there's no volatility in future, right? So I don't say any macro risk, to be frank. It's volatility and it'll pass. That said, I
Okay.
am not
Okay.
recommending
Yeah.
any of these stocks. Please understand.
No, no, that's so clear, and thanks a lot, Asit, for answering this in the most sophisticated way. Um, so it was like an incredible session and time what we had, Asit, with you. No new questions coming up at this time, but definitely if it comes and it has directly related to you as being the expert, then I'll transfer the same to you. Okay.
Sure, please.
It's like an amazing time what we had, and because the market has been changing very rapidly these days, and because of the volatility, I think these were the top questions which our investors they were interested and to know more about it, and you covered it very well. So again, thanks a lot, Mr. Asit, for that. And of course, heartfelt thank you for each and every one of you who participated in this webinar. Uh, we will be soon sharing the Gift City deck also that will give you some more idea about how it works. And for the mutual fund, obviously, you have the SBNRI app in place. So if there is any doubt or questions, you can reach out to your relationship managers in there. And via email, you can reach out to us if you had some questions related to JM Financials or the market. Would be happy to assist you in there. We'll be looking forward to catch up soon in our next webinar. Thanks a lot,
Thank
everyone.
you very much.
Thanks a lot,
It's been my pleasure. Yeah, and I'll just have a passing line. We are looking at dark clouds, we are looking at volatility, but also please look at positive things that are happening around us. One of the things that has happened today.
Absolutely. A great closure from your side.
Yeah, pleasure.
Perfect. I wish you everyone a very lovely weekend. Enjoy your time, guys.